welcome to today's session of Indonesia Property Market Update for the first half of 2022, Developers and Investors session. Thank you for joining us this afternoon. Before we start our webinar today, we have a few information in regard to today's session. The first one is the audio and video for this webinar participants are being disabled to avoid noises, and we will only enable audio and video for our panelists today. This webinar is being recorded, and we will share the recorded file and presentation slides tomorrow morning. We will have a question and answers session at the end of our webinar, but please feel free to type your question in the question box below. And although we may have a limited time to answer to your questions, we will send the unanswered questions to your email inbox. If you need any help with the webinar, please type your question in the chat box and our webinar host will help you. And along with the recorded version tomorrow, we will send a survey link for you to fill out. We appreciate your time to fill out the form. Before we start our presentation, I would like to introduce you to our today's list of speakers. The first one is our keynote speaker will be Bapak Mike Broomell, our Managing Director of Colliers Indonesia, followed by Ibu Monica Koesnovagrill and Bapak Steve Atherton as the Head of Advisory Services and Head of Capital Markets and Investment Services, respectively. They both will speak about investment markets. And followed by Bapak Ferry Salanto. Bapak Ferry Salanto will start each of the sectors that will be discussed today for his observation of the first half of 2022, followed by Bapak Bagus Adikusumo as the Head of Office Services, Halsema as Head of Retail Services, Bapak Martua Simarmata as Senior Associate Director of Industrial and Logistic Services. Bapak Martua is replacing Bapak Rifan because Pak Rifan is not able to join today. And last but not least, Bapak Satria will discuss about the hospitality services. So without further ado, please welcome Bapak Mike Broomell as our keynote speaker for today. Pak Mike, the floor is yours.
Thank you, Auntie. Good afternoon to everyone, and thank you for joining today's webinar. I'll be making some general remarks at the beginning, and as Ibu Auntie said, after that, you'll hear from my colleagues, but I'll just give you a brief overview of some of the different asset classes before I turn it over to them. I'd like to talk about some general trends that we're witnessing. Over the last quarter or so, we've seen a renewed interest post-pandemic from foreign investors and developers. We're talking to many of them, and a number of them have been traveling to Indonesia after 2 or 2.5 years of not coming here. So that's very encouraging. They're scouting out opportunities. In some cases, they're looking for distressed assets. Companies that either have properties that in and of themselves are having difficulties, or assets that are owned by companies that are having difficulties and they need some additional cash flow, so they're looking to dispose of those assets. But in other cases, they're just seeing that post-pandemic, there are a number of opportunities in the market, and they'd like to invest and develop in a market where they see a lot of potential growth in the future. There are concerns, I think, around the world about increasing inflation, higher interest rates, and a recession. I think it's almost confirmed, I believe, that the U.S. is in recession, and that may have an impact in other countries around the world. But we feel like Indonesia is very blessed to have to be rich in natural resources. I heard coal prices are at an all-time high. And of course, we have a lot of nickel here, which is quite good for the EV industry. And finally, in terms of general comments, we are seeing a definite increase in interest in ESG, particularly the E part of it, which is the environment. Developers, investors, and even occupiers are looking to be certified. And that's something that we haven't seen in 2020 or 2021. So that's an area where I think developers and investors and occupiers are going to be interested in. And I think if I was a developer and investor, I'd pay particular attention to that trend. In terms of the different asset classes, generally speaking, you'll hear more detail from our colleagues, my colleagues, but industrial and logistics tends to be and continues to be very strong. We have seen over the last few months the purchase of some existing logistics developers. There have been some changes in ownership in places like Pacific Vantage, also in SLP, and we are also seeing some new players come into the market. So I think that's an indication of the interest and the strength of that particular sector. Data centers, which often are inside industrial estates, but not necessarily. We've seen an interest, great interest from foreign investors that takes a lot of capital. And we feel like a lot of foreign investors are the ones that can provide that capital. Land and residential, as has been true throughout the pandemic, that continues to be strong. And hospitality, we've seen a definite rebound, both on the business side and on the leisure side. But I think after the pandemic, people are a little bit wary about investing in hospitality just because they see the volatility of the income stream. Office is probably one of the sectors that is most uncertain in terms of at least my view. Even before we went into the pandemic, we had quite a high vacancy rate. And now after the pandemic, people are trying to figure out where we are going forward, whether it's working from home, working from the office, working from anywhere. The number of days per week that people come into the office varies greatly by company. In our office, we are asking people to come in about 50% of the time. Some of our competitors are requiring people to come in 100% of the time. And the reason we're doing it the way we're doing it is because we understand, because of the odd even traffic situation, a lot of people will be bringing their cars in, and it's very difficult for them to come in on an odd number day if they have an even number license plate. So I think various companies are trying to find their way around. I had an interesting conversation with one developer that mentioned that he saw a definite difference between tenants that were MNCs versus tenants that were local. And he said that most MNCs are a little bit more flexible in terms of their employees not having to come in, whereas with a lot of local companies, they're requiring their employees to come in all the time. And even I noticed differences in days of the week. In our office, I noticed Wednesday, we tend to be quite full. Mondays and Fridays, not so much so. So I think it's a very difficult situation in terms of the office market, knowing what the demand is going to be going forward. More and more companies are looking to hire companies like ourselves that provide workplace strategy. And I think one of the things that has been a surprise to me as well is that the traffic situation isn't any better than it is, because with as many people that work from home as are currently working from home, I would have thought that the traffic would not be as bad as it is. But I guess many people are avoiding mass transportation, the MRT, for example, because of the fact that they're afraid of getting COVID. But I think over time, hopefully the traffic will get a little bit better, or it may continue to get worse as more and more companies are asking their employees to come into the office more than previously. The office market situation long-term, though, may change as the traffic improves, and if we implement the ERP system as we're planning to do, we won't have the odd even traffic situation, and we may see people return to mass transit, so the office market could be a little bit healthier a couple of years from now. But as I said, it's still a little bit uncertain. And then finally, the remaining sector is retail. Mall traffic, as I think most of you would probably recognize, has picked up a lot. I heard it's even greater than pre-pandemic in many cases. But in the CBD, the retail market is still struggling. We find a number of retailers that went out of business during the pandemic, and there aren't as many choices of places to eat. So retailers are a little bit reluctant to open up in the CBD now because the traffic from office tenants has dropped quite a bit from where it was before. Anyway, I hope with the overview, you've gotten a little bit of insights on the market in general, but I'd like to turn it over now to my colleagues, and they can give you more detail on the markets, and please feel free to reach out to me or any of my colleagues with regard to questions you may have, and we'd love to be in touch with you and provide you with whatever information we can. So thank you very much.
Thank you, Pak Mike, for the remarks. We will move forward to our team for investment. Ibu Monica Koesnovagrill will start her overview of the market, and then followed by Bapak Steve Atherton as the head of capital markets and investment services. Ibu Monica and Pak Steve, the floor is yours.
Okay, thank you, Auntie. In investment classification in Indonesia, property is classified under services industry. Hence, this chart is showing the trend of investment value of services industry. The horizontal axis in left chart shows here, whilst the vertical axis shows value in trillion rupiah. The dark blue column shows domestic investment and the light blue one shows the foreign investment. Domestic investment in services industry has shown 24.7% annual growth since 2017, whilst the foreign investment had 10.2% annual growth during 2017 to 2019, before pandemic made it having negative annual growth of 16.1%. The right chart shows the breakdown of services industry during first quarter 2022 for either domestic or foreign investment. The left column shows that about 80% of domestic investment in services was related to property, being dominated by transportation, warehouse, and telecommunication by 20%, and residential, industrial estate, and office building by 13%. Whilst the right column shows that about 55% of foreign investment in services was related to property, again being dominated by transportation, warehouse, and telecommunication by 9%, and residential, industrial estate, and office building by 5%. Hence, both charts shows that property is still preferred investment sector for either domestic or foreign investors. Next slide, please. The interesting investment data is also shown in the market. The detailed explanation on each sector will be elaborated by my colleagues in respective expertise. However, I will try to provide a macro picture for three major components: logistics, data center, and TOD. Logistics has been growing in balance between supply and demand. Hence, occupancy was moving between 86% and 95%. With the massive infrastructure development and the concentration of major manufacturing companies along the east corridor of Greater Jakarta, i.e. Bekasi Kerawang, logistics are also concentrated mostly within this area. However, with the construction of Trans-Java Toll Road, investors started to eye on other areas along this road. Huge population in Java, about 152 million people, has become major attraction for e-commerce as one major market for logistics. Hence, logistic market is now expanding to different areas and also attracting more players, domestic or foreign players. For data center, internet users in Indonesia has been growing by 17.3% per annum for the last 6 years. Further, internet penetration in Java range between 70% and 85%. This becomes major factors for data center developments in Indonesia. Yet, as year to date, only about 40 facilities are available in Indonesia, of which 80% are in Java. Hence, big market potential is available in Indonesia. TOD, with very high land costs, traffic congestion, long traveling time, and low air quality in Jakarta, TOD becomes one solution to have work-life balance. Again, high working population in Jabodetabek is the major attraction for TOD. As year-to-date, apartments developed within TOD could be broken down into two different groups. Those in adjacent to railway or LRT are marketed at between 400 and 500 million per unit for commercial pricing, or between 200 and 300 million per unit for subsidized units. Whilst those adjacent to MRT, being located within the commercial area, are marketed as higher price at about 1 billion per unit. Next slide. The new capital city is located in Penajam Pasir Utara Regency, East Kalimantan, between two major cities in this province, Balikpapan and Samarinda. As year-to-date, to go to this area, you should go from Balikpapan or Samarinda. Since the area is still within forest, it will take about 2 to 3 hours from Balikpapan by road. Whilst another route, this is what I took during my trip there, you take boat along the Balikpapan Bay to a small port at Penajam, and then take road trip to the new capital city. This will take about 1 hour. However, in the future, the government has developed infrastructure to shorten the traveling time from Balikpapan to the new capital city, to comprise of toll roads and tube bridges connecting Penajam, Galang Island, and Balikpapan. It is expected that the entire infrastructure will be in operation in 2024. Should this work be completed, traveling time from Balikpapan to the new capital city will be 30 to 45 minutes. The development area of the new capital city will comprise of 3 areas: government core, capital city zone, and expanded metropolitan area. The first development phase will be focused on government core, i.e. presidential palace, government offices, housing for government employees in the form of landed houses and apartments and infrastructure. And what is also interesting is that within the first phase, the government would also have mangrove revitalization. Later, more commercial and industrial developments are also required in the other zones. A proper master plan for the area from zero condition would become big advantage of this development as the new capital city of Indonesia. Thank you, Auntie.
Thank you, Bu Monica. Over to you, Pak Steve.
Thanks, Ibu Auntie. Overall, since the travel restrictions and social mobility restrictions have been relaxed in Indonesia, investment appetite for property investment and development has been increasing. Foreign investors and developers are now revisiting their Indonesian investment strategies, the current market conditions, changes in regulations, and re-exploring which asset classes and opportunities to focus their energies. From a high-level perspective, the top performing asset classes at present are landed housing, logistics, and data centers. These are the sectors getting the most attention. Selectively, there is interest in hospitality and retail. Expectations are that hospitality and retail can rebound relatively quickly post-COVID. The most challenging sectors remain office and apartment. However, there are exceptions like sub-market supply-demand imbalances for office and recurring income potential of residential uses for apartments like co-living, serviced apartments, rental apartments, student housing, and senior living. Some of these alternative investment products are currently under evaluation by developers and investors. We can see from the slide on the left, the Indonesian GDP Q1 2022 at 5.01%, and now forecasted around 4.7% going forward. Fortunately, our economy is not heavily dependent on exports, and we have a large domestic economy with strong local consumption. We also have enjoyed a strong commodity market that has helped maintain stable currency and demand for rupiah. Inflation in the center of this chart is showing some increases as we touched 4.35% in June, but this isn't as bad as the US, which recently touched 9% in June. That's the highest inflation in 40 years. We do hear from property developers about rising construction costs, and ultimately there will be pressure to pass those increases on to buyers. And if inflation continues to trend higher here, there will be mounting pressure on Bank Indonesia to increase interest rates. We can see on the far right of the chart, Bank Indonesia 7-day reverse repo rate holding so far at 3.5% for around the last 18 months. In contrast to the US Federal Reserve increasing the federal funds rate rapidly from near zero range at the start of the year to plus or minus 1.75%, with expectations it could go as high as 3.25 to 4 or higher. Next slide, please. Buyers continue to use home mortgages for landed housing and apartment purchases. We could say in the 70 to 75% range of all purchases are using mortgages. We can also see the average mortgage interest rate sliding from June 2020 at just under 9% to 8.11% currently, whereas the 30-year mortgage rates in the US have increased in the last 6 months from just under 3% to just under 6%, a rise of almost 3%. Lastly, we can see some of the major listed developers who primarily build and sell landed housing continue to maintain their level of property sales. Next slide, please. These last slides show the relationship between the historical rise in commodity prices and the corresponding rise in the property market. We can see the commodity price rise in the 2009 to 12 period and the corresponding property market growth. Perhaps COVID has muted some of the normal growth we would expect in the property sector on the back of recent rise in commodity prices. Hopefully, this will just be a lag effect due to all the dislocation in the global economy with COVID, the Ukraine-Russia conflict, supply chain disruptions, and whatnot. In closing, we are continuing to see local and foreign developer demand for landed housing through land acquisitions for smaller to larger landed housing clusters, including larger sized townships of 100 hectares and larger. Foreign capital and developers are now very interested in this space. Foreign investors also continue to seek logistics opportunities for recurring income and development. Recently, there have been some new activity in the formation of development platforms for logistics by local, foreign, and JV companies. We still see a lot of foreign investment interest in this space. Data center investors and operators continue to explore partnerships and new greenfield projects, both in the industrial estates and the CBD. Even though competition and supply may be rising quickly in the short term, Indonesia is still perceived as a large, attractive, high-growth market. For the hotel space, with the difficult COVID experience causing major disruptions, some local hotel owners are seeking to divest or seeking co-investment for renovating and upgrading their portfolios. This is an interesting space to continue watching going forward. Similarly, some of the retail mall owners are looking to monetize their assets. While COVID hit the retail industry hard, the rebound is underway and extremely fast in some cases. For offices and apartments, including existing, under construction, planned, and even land for office development, these remain the most challenging sectors, but pricing is probably at the most attractive levels seen in recent memory. Perhaps some contrarian investors might look smart in 5 years if they selectively buy low now when others are selling and sell in the next rising property cycle. That wraps up my comments on the investor sector. Thank you.
Thank you, Pak Steve. We will move to the office sector. Pak Ferry Salanto, as the head of research, will open the sector, and followed by Pak Bagus Adikusumo as the head of office services. Pak Ferry and Pak Bagus, over to you.
Thank you, Auntie, for the time. Good afternoon, all. Okay, let's take a look at the first slide. We are going to talk about the office sector here. Here I have two charts explaining the growth of annual supply and with our projection as well. Well, if we compare office to other sectors, I would say that this sector has experienced a great pressure from the oversupply situation even before COVID pandemic. During the second quarter this year, no office project has been completed. Cumulative supply in the CBD stayed at about 7 million square meter, and in the outside the CBD, almost 3.7 million square meter. From our field finding, number of groundbreakings is slowing down, but still some projects are underway. If we look at the charts, the good thing about supply is that we expect supply to grow only about 2% from 2022 to 2025. And thus far, we see that the addition of supply will be very moderate. We think that this will help regulate the oversupply situation and also improve the overall occupancy performance. The fact that 2024 will be a political year is also positive because there will be limited supply coming in and business is generally in the wait and see mode. Next slide, please. Okay, here we also have to chart the occupancy performance in the CBD and outside the CBD. So office occupiers have started gradually switching back to working from the office. We found that many companies started to seek sustainability and technology integration and prioritizing employee health and wellness. The improving health outlook, particularly with the slowing cases of COVID and the resurgent economy, should support a recovery of office leasing activity. So in this case, occupiers can continue to capitalize on highly favorable market condition due to vacant space glut. From the landlord side, a swift economic recovery is expected to enhance business confidence. Average occupancy rates have yet to show post-pandemic improvement. Restriction on office activity have been lifted, allowing companies to implement work from the office at 100% capacity. So this is expected to increase demand for office space. We also see several companies such as service or consulting company, ministries or government, finance related, community association, energy and agency are actively looking for office space both for expansion and relocation. So, and also social media platform companies require larger space for their head office. Next. Okay, so far there is no strong catalyst for landlord to increase rentals, at least until the end of 2022. However, the operation of new building with better qualities will have an effect on the average rent calculation in the CBD area. In the outside the CBD, landlord with relatively low success in securing committed tenants are likely to keep rental rates at around the same level in order to pursue a healthier occupancy level. And we also see that subleasings becomes an attractive survival strategy during hard time in the strata title market. Some strata title office set more competitive rent compared to the office under lease scheme. This is intended to immediately fill the vacant space and help landlord or units owner to cover service charge costs. think that's all from me for office market outlook. I'll give to my colleague, Pak Bagus, to continue. Pak Bagus, over to you.
Thank you, Ferry, for the presentation of office market. Thank you, everyone, for joining our webinar. Continue with what Pak Ferry has been saying. So office market, as you can see, still a new supply coming until 2025. So office market will still be continued, the oversupply. And then because of the oversupply and then the limited demand, rent and occupancy rate will be pushed down. So at the moment, the office market is geared towards standards market still. Now, one thing that has been changed from last year is that demand for office space starting beginning of this year, first half of this year, is actually picking up. So that is a good news. And then another good news is that majority of those inquiries of companies in the first half of 2022, majority of them is actually executed the relocation plan instead of extending the lease. It is compared to last year, a lot of inquiries that not as many as demand for this year. They look for office space, they do the study, they do the process, but at the end of the day, last year, most of them actually decided to extend the lease. So that is a good news overall, because companies have adjusted to the way they're running business with the pandemic. Major occupiers still dominated by e-commerce, consumer products, government-related companies, and logistic. Even though recently we have seen a lot of information whereby the startup companies, including e-commerce, have got their own challenge, whereby they, because of the global climate and also competition of the business, some of them actually shut down their operation. Some are actually downsized quite significantly. Hope it will not impact so much to the Jakarta market. Next slide, please. Now, in terms of hybrid working system, after 2 years working from home because of pandemic, so Colliers have done the survey, actually it's globally, first half 2022, 77% actually of the companies that we survey has decided to continue hybrid office approach. And then 69% of the 77% have actually set the number of days for each employee to be in the office. So the result is 3 to 4 days a week working from office, and then 1 to 2 days a week working from home. This is actually is quite different from our own question to all the participants today. We throw a questions, and then the result is 61.80% actually. The participant that here today is already working from the office. And then 16.25% is 75% working from office. And then 12.72%, 50% working from office. And then only 3.89% still working full-time from home. So that's very much different. And the difference is because a lot of multinational companies, as our managing director has pointed out recently in the earlier opening, is that yes, it's different from multinational companies and local. So most of the local companies applying 100% working from home after the government decided to do PPKM level 1. And one thing to be pointed out also, 49% of the companies anticipated of making significant changes in their office design. So they will get rid of the fixed desks. They'll be providing more open desks, mobile desks, which is called hot desking. So a lot of more like community-based design, a lot of collaboration instead. Now, in terms of the co-working space, after 2 years, their business is basically corrected and then got a challenge. So they have basically running a healthy and more profitable business now, after they re-evaluated actually the number of the centers they have by either closing down their center office or reducing the space or renegotiating the commercial terms. And then co-working space is still needed in the future because they provide flexibility. They provide the short-term period, whereas in the traditional lease, you can only do 3 to 5 years. Well, co-working space providing more flexible, could be 1 monthly basis, weekly basis, 3 months, 6 months, so more flexible. Next slide, please. Now, this right now is actually the time to analyze when a lot of companies decided to come back to analyze basically whether or not hybrid office approach really works, right? So in the past, a lot of when we do have meetings, we only do all online, but now is half online and half offline. You know how productive the working of the hybrid office approach really works. So that's yet to see. And then in terms of the building itself, you know, now a lot of building has not been in full operation, but now people come back to the office in a full capacity. So see whether M&E is working, you know, genset, AC, you know, so overall building system is actually being checked right now because of the PPKM level 1 allowing 100% full capacity. And then one thing that is good news is F&B retailers in the office building, because at the beginning of the pandemic, towards the pandemic, they either closed down or they negotiated their rent. But now when we are come back, a lot of F&B started opening up because the building is crowded, lunch is crowd of people right now and employees coming back. So we're in the World Trade Center, we see one by one retailers started opening up. So business is back healthy and more profitable. Then one thing that is challenging also here is that space that was absorbed will come available again. What I mean by this is that when company reduce the space because of the pandemic, when they renew their lease, they reduce the space because after 2 years, they work from home, the space is not used, but they still continue paying rent. So those space that is actually already absorbed in our research report become available again. So add it to the supply that is already offered. So this is quite challenging for the office market in the future. And then another thing about our global recent survey is 43% of the companies globally, which is mostly multinational companies, have not really stated when they're going to come back to the office. So it's very contrast from Indonesia. Globally, 43% still not yet when they go back to the office. So they're still working full from home. So that's interesting to point out here. And then ESG becoming the trend, as Pak Mike has mentioned. So a lot of company applying ESG policy. So when they decided to relocate to a new building, they prefer to be in a certified green building. Some companies applying as a compulsory, some companies applying still as a preference. Next slide, please. Related to our last point is that a lot of building right now in Jakarta is not green building, because the fact of the certified green building is just becoming the trend and becoming the requirement is just recently. I would say the last 3 to 4 years, you know, maybe 5 years. So, but now with the ESG, a lot of companies applying those and then decided for their branches, their companies that are located in all over the world, including Jakarta, including Indonesia, when they move, they have to move to a certified green building. Now, unfortunately, the government has not yet provided the incentive for the landlord to apply or change from a non-green building to become certified green building. So far, right now, the landlord is actually motivated and refund the fact to move to non-green building to a certified green building by the tenant's requirement, because they would like to be selected for the next process and hopefully to be the final building to choose for the tenants to move to. Next slide, please. Now, the last slide is about the new capital city. How does the movement of new capital city moving from Jakarta to Kalimantan for the office market? Number one is, as I mentioned early on in the last slide, is that government companies, actually one of the major occupiers, right? State-owned company, government institution, they keep expanding because their current office building is not enough. They move and rent in the commercial building. So those requirements are gone. So it will be a demand reduction for office space. Additionally, the building that will become vacant because they move to Kalimantan will become available for companies for rent, for lease. Even though I know most of the government building needs to require some renovation or improvements, but at least when those buildings have become renovated and ready and then improved and ready to be available in the market, and then after meeting the commercial leasing requirement, that will add it to the supply. So that will be another challenge. And then another thing that have come into our attention recently, we also received inquiries from a few companies that have their large parcel land located very near to the new capital city. They ask us a question, what are the opportunity for them, or whether or not is there any exact progress of the new capital city? So what are the opportunities for them? Can they build housing for the government employees, or can they build any property type that is complementary to support the new capital city? So those yet to know, So we are now basically waiting to see what is going to happen about the new capital city in 2024 and 2025, because that's what the president has mentioned. They will start moving and start operating in a new capital city in 2024. That wraps up office market overview. Anti, turn over to you.
Thank you, Pak Bagus. We're moving to the next sector, which is retail market. Bapak Ferry Salanto will start with the updates on the first half of 2022, followed by Sander Halsema, which will give his point of view on what happened in the next half of 2022. Pak Ferry and Sander, over to you.
Okay, thanks again, Auntie, for giving me the chance. Okay, before I give it to Sander, let me brief you an outlook about the retail center, what's happening so far, and what will be the outlook for this year or the next year. So in general, we don't see any big issue if you look at the supply side here, because in shopping center industry, it is not only about occupancy, but also it is about the traffic or the crowd coming to the mall. Until today, there is no new mall completion, making the cumulative supply in Jakarta was registered at about almost 4.9 million square meter. And this has been stable in the past 6 months. So the cumulative supply in Greater Jakarta on the other side also see no additional new supply, making it stagnant at about 2.9 million square meter. And the total retail space supply will be around 500 square meter, with about 70% in the Greater Jakarta area. So the majority will be coming from the other part of Greater Jabodetabek area. So the cumulative supply is expected to increase 1.6% per year during 2022-2025. The retail sector, we expect to recover relatively well from the pandemic major disruption. However, the landlord will still maintain the same cost of occupancy. If you look at the chart below there, landlord prefer to reduce or minimize some incentive provided to tenants during the pandemic. So as a result, overall rents have remained stagnant in the first half of 2022. Now rent is registered at about 566,000 rupiah in Jakarta and about 384,000 in the Greater Jakarta area. And in line with the expected demand improvement, some shopping malls are already have waiting lists or prospective tenants, and we likely be more confident about increasing occupancy costs, but will be very moderate. Next slide, please. Okay, here we see occupancy performance for retail, and we see that we think that demand is expected to improve, but the addition and the completion of new shopping malls will likely impact the average occupancy rate calculation in the coming years. So in Jakarta, if we look at relatively limited future supply projection, occupancy is expected to trend upward up to 2025. But in Greater Jakarta, a larger projected additional supply will challenge projected occupancy rates in the next 2 or 3 years. So the good things about the easing policy of public movement restriction can be seen in the mall traffic number that has improved and reached about 80% of visitation number during the normal period. We have some information for, we do research several malls in Jakarta, and we found out that the condition of traffic coming to the mall during before the pandemic and during the pandemic, especially during 2022 and 2021, has dropped by almost 40%. So that's a big drop in the mall industry. So now we see that the holding of more event and exhibition previously disallowed under COVID restriction now is going to contribute the atmosphere in the mall and is expected to help speed up recovery in the retail sector. That's pretty much about it about retail. Now I give it to my colleague Sander to continue on what happened in the market as well. Over to you, Sander.
Yeah, thank you, Ferry. Good every afternoon, everybody. Thank you for dialing into this webinar. The first half of 2022, we saw positivity returning in the retail market. Many national and international retail brands started to fully focus on expansion again, trying to reap the benefits of landlord flexibility and strong locations which are currently available for rent. We also see a lot of foreign retailers from China and Japan coming to Indonesia to expand their business here in this market. And for national tenants, we see an increasing collaboration between landlords and UKM, like for example in Sarina, where more local brands and galleries are opening up to attract new customers, to offer local product and to fill vacant spaces. This is all supported by the Indonesian government, which is emphasizing the importance of the retail sector in contributing to the recovery of household consumption. By organizing the 2022 Retail Summit, they also hope that that summit can help increase domestic consumption and create opportunities for SMEs, the creative sector and shopping centers throughout the country. If we look at the occupancy, like Ferry and also Mike have stated, many landlords saw traffic coming back to their malls, with many stating that their traffic has reached about 80% of the pre-COVID numbers. Obviously, these numbers differ per mall, as some malls are still working to recover from the COVID period and the loss of many good tenants in their assets. But in general, I think we can state that traffic has been increasing each month, with large crowds going to the major malls in Jakarta area over the weekend and in the evenings during the week. Now, if you look at the rents, landlords continue to focus on increasing occupancy and prefer to maintain the same rental rates in the past 6 months. Nevertheless, we, like Ferry said, we still see a slight increase in the average rent in the Jakarta area due to new retail assets coming onto the market. And some malls that have maintained a high occupancy rate during COVID and post-COVID are likely to consider setting new and higher rents going forward this year. Next slide, please. So over the last few months, we received lots of questions about the impact of e-commerce on physical stores and the relevance really of brick and mortar stores. We obviously saw a massive increase in e-commerce sales, online sales during the pandemic. But now we see more and more pure e-commerce players that have discovered the relevance actually of brick and mortar stores and have started to open up physical stores like JD, for example. And this is a phenomenon we see not only in Indonesia, but also elsewhere in the world. And the reason really is because with a pure e-commerce model, margins are very thin and logistic costs, among others, remain to be high. We have stated in earlier webinars, but the brick and mortar stores will always be very relevant. And in the post-COVID area, they're back, although I would like to state that they have never been gone. So different necessary COVID measures by the Indonesian government had impact on mall visitations, on offline retail sales, and consumers were during COVID obviously reluctant to surround themselves with large groups of people. But now we really see in the post-COVID era that visitation is picking up and consumers like to visit physical stores to experience product and to hang out with their friends in different F&B outlets. But I would also like to state that both mall operators and retailers need to continue to work hard to stay relevant. Consumers expect more and better experiences and want to be pampered really. So the mall operators and retailers that manage to do just that will be the ones favored by many consumers. During the COVID period, we saw an increase in demand for standalone outlets, so that retailers could manage their own opening hours, work closer to their consumers in residential areas, and could use these stores as online fulfillment centers. You might remember I explained that in the last webinar. This phenomenon is still there, although we also sense right now that most retailers prefer to open at malls so that they can reap the benefits of higher foot traffic. Standalone sites are still sought after, but mainly by stronger international and national brands that will have a strong pull factor to attract consumers to their stores. Bagus also mentioned about the retail and office buildings. The retail and office buildings remain to struggle a bit over the last 6 months. There were many very good units available at different office locations. But again, F&B retailers were, just out of the pandemic, they were really seeking for higher traffic of the shopping malls and prefer to be able to operate their outlets 7 days a week compared to only 5 days at office locations. Obviously, office owners, they need to provide good facilities and F&B options to their tenants, and hence, right now, they tend to be a bit more flexible towards potential retail and F&B tenants. Over the last few months, we have seen an increase in demand for retail space at offices by many F&B retailers, and so we expect more transactions here in the coming 6 months as office workers have returned to their offices. Next slide, please. So we see different opportunities for mall developers and owners in the current market. Just like we mentioned in the previous webinar, we continue to see larger retail groups asking for revenue share structured leases. Although this holds a certain risk for owners as income is less certain, it does also offer opportunity for higher income if the tenant is overperforming or above expectations. And it offers opportunity to attract anchor tenants looking after this rent structure to fill up larger vacant spaces at certain retail assets. Consumers are experience seekers nowadays, like I said earlier. They want to be amazed and will go to places that offer them the full experience. This offers opportunities for mall developers and owners to select and attract tenants that can offer great experience to their consumers, and requires mall owners to have an F&B tenancy mix that offers great choices for their visitors. Malls that stand out with their tenancy mix and offer that experience will see a higher footfall and a wider variety of visitor profiles. And last but not least, following my point made about e-commerce on the previous slide, brick and mortar stores are still very relevant, and the retailers that implement a strong omni-channel strategy are the ones that are most likely to thrive. As physical stores still serve as fulfillment centers for online purchases and online food purchases, mall operators need to continue to help their tenants to make the order fulfillment process as efficient as possible. This can be done by providing designated areas at their assets for Grab and Gojek drivers, which many malls are already doing, by making parking free for Gojek and Grab drivers, and to potentially implement a single pickup point within their mall so that tenants can bring their online orders to that location for Grab and Gojek drivers to pick up. So that wraps up my updates for today. If you have any questions, please do not hesitate to reach out to me. Thank you.
Thank you, Sander and Pa Ferry. We'll move along to the next sector, which is industrial and logistics market. Again, Pa Ferry will start with the presentation, followed by Bapak Martua Simarmata to discuss about the property opportunities in industrial and logistics services. The floor is yours, Bapak-Bapak.
Thank you again, Auntie. Okay, before I give this session to Pak Martua from our industrial division, first of all, I would like to emphasize what Pak Mike mentioned in the opening, that the industrial sector has basically entered the recovery phase earlier than any other property sectors. Of course, if you look at the chart here, sales is one of the ways to measure the transaction volume performance. So the momentum started basically, if you look at the chart again in 2019, when the total sales volume was double to what of the previous years, but the pandemic struck and sales declined. So COVID ruined the projection of all property sectors. However, we still see prospect of a positive outlook in the industrial sector, mainly from the pent-up demand materializing when the moment is right. So almost about 55% of the total taxation for 2021, or about 115.2 hectares, were recorded in the first semester this year. And this is a signal of an optimistic outlook for the industrial market, because since 2019, sales in the second half of the year has always been higher than sales in the first half. So that's basically the pattern. So this pattern suggests that total sales in second half or second semester this year will possibly outstrip what is happening in first half 2022, which in turn will produce a better annual result compared to 2021. Next slide, please. Okay, we have two charts here: the prices and what are the active sector in the industrial transaction. So from the perspective of a landlord, another performance to measure is pricing. This might not be in line with the gradual land absorption as we saw earlier in the first chart, but we still see that this should be acceptable in the current situation, where the gradual increase in transaction volumes and land inquiries have had a little impact on the land price increases. But industrial estate with high levels of activity have adjusted prices slightly. Nowadays, the focus of most industrial estate is more on accumulating sales volume, while they believe that price will follow. Such a situation is what we have witnessed over the past few years, and landlords are in the position to maintain the current price and be more accommodative in discussing terms. The industrial sector will gain more traction, we believe, in the long run, with the high-tech industry continue to expand until recently. Up to the first semester this year, the predominance of the technology sector, including data center, has quite obvious. This high-tech sector is heading towards maturity with more potential transaction in the pipeline. So another sustainable sector is logistic, which has been mainly stimulated by the growing need for storage and distribution. The growth of the logistic sector will stimulate for good location and accessibility. I think that's all from me for the market update. I'll give it to Martua to continue.
Yes, thank you, Ferry. Good afternoon, everyone. Now we're talking about the industrial and logistics sectors. As we can already hear, or we can see in the market, that basically there's a change in property industrial climate. Recently, we see that the government pays great attention to the sectors because of the large amount of the investment, obviously, which interest in Indonesia, especially from foreign investors. These are quite a lot of teams from overseas who come. So when the government changed the restriction of travel restriction and also the quarantine regulation at the beginning of this year, we see many quite teams from overseas that came to inspection, which the situation become opportunity as they are attracted to invest, which was delayed due to the pandemic. We can see that the government in Indonesia wants to open more opportunities to compete with other Asian countries. I think I will answer to Benjamin's question later on. Next slide, please. Okay, so when we're talking about the investment, I give you a bit the trend of the market. As you can see from the investment trend from 2010 to 2015, we can see that the main major investors basically automotive related industry in Indonesia. And then in 2020 to 2021, we can see the growth of warehouse logistics, e-commerce, and data centers. It's become, and then they grow so rapidly, very, very strong. And now the 2022, moving forward, we can see that the type of investment or new investment that come to Indonesia is basically still data center, but also electric vehicles. We see the emergence of potential for electric vehicle business on industrial estates. There will be need for electric vehicle battery components factories, battery exchange stations, battery recycling industry, and also R&D and training, as well as many other derivative industries or related industries to this electric vehicle investment. Next slide. Okay, when we're talking about the industrial and warehouse and logistics, we also will ask about the type of warehousing. The type of warehouse, basically the factors that which has factors in warehouse. We consider the growth in e-commerce now is not as rapid as in a previous period. There's still a trend to go up, but not as 2020 or 2021 last year, where it goes up so high, so fast. Still grow up, but not as rapid as the previous period. The trend of e-commerce will always increase, because of there's still many rooms to expand in this e-commerce sectors. And the growth for FMCG warehouses projected to be steady. Next slide. So when talking about the logistics of warehouses, the next question is basically, where the location for the logistic or the warehouse. The location selection is determined by several factors. We can see that the customer driven. For example, if the logistic service factory A, then they will prefer to have a warehouse located close to the factory A. And then the client orientation. Basically, if the business basically has frequent or high frequent connection to the seaport or airport, then the logistic will be goes to around seaport and airport area. And then the next one is basically the location of the warehouse is determined by the infrastructure, the road access. Why? Because of the logistics has a strong relations with speed, with access to move one goods to another area. That's why the infrastructure location is very strong. You can see on the map, there's number 4. Basically, number 4 is Cibitung. This one is one of the anticipated toll or JO2, which connect from Cibitung to the northern part, to Cilincing, and also the southern part from the number 3 from Cimanggis to Cibitung. If these two toll road connect from south to the north, it will speed up the logistic or the speed of goods movement from the south to the port, and that will also help to solve condense instead of going to Cakung Cilincing toll road. Yeah, so these two the toll will be operated by end of 2023, if I'm not mistaken. Yeah, So we're looking forward for that one because that one will be have a good impact in logistics in Greater Jakarta. I think that's all from the industrial. Back to you, Auntie.
Thank you, Pak Martua. We're moving on to the next sector, which is apartment market. Pak Ferry will start with the charts and then followed by Pak Steve Atherton to explain about the updates and opportunities. Over to you, Bapak-Bapak.
Okay, thanks again, Auntie. Okay, here we have two charts. In the left is the cumulative supply and its projection, and we also add information on the number of annual supply addition. Okay, you can see also from the chart that the annual supply in 2020 and 2021 were quite limited. There are some projects deciding to hold off their handover time as construction remain slow. Similarly, some future projects postponed their launch, which led to the assumption that many developers were not quite firm in introducing new projects. So consequently, we have to adjust our supply projection from 2022 to 2025. About 21,319 units will be completed, which is 17% less than our previous projection in the first quarter this year. The majority of projects in the supply pipeline is located in South Jakarta. Now, in the right, you can see a number of units being absorbed every year. This is basically has been trended down even before the pandemic. So most apartment buyers are still motivated to invest. We estimate around 60% are investor buyers that typically seek for yield and capital gain. But the market is currently a bit stagnant, which we can see from the relatively low rent and sluggish price appreciation. And further, we find that lessee is still very challenging while they are still obligated to pay maintenance and utility fees as well as annual building and land tax. Apartment units may not be a lucrative asset in this current market situation, and so it is not a liquid investment item. In addition, the primary market or first-hand units is currently losing its appeal, and the secondary market could be offered at very competitive price and is even sometimes fitted out as furnished units and that are less expensive than new ones. Next slide. Okay, now if you look at the above left chart, prices have been relatively flat as only a few apartments have increased their asking price. I would say slightly. The average asking price has moderately adjusted by less than 1% year on year to about 35.2 million per square meter. The most increment occurred in the non-prime areas, which is outside the CBD and South Jakarta, especially in the West Jakarta, where most transactions took place. Majority of project has maintained their asking price to anticipate competitive offer from the secondary units. Based on our finding, the price gap between primary units before VAT and the secondary unit rise from 5% to 20%. And consequently, more customers consider taking secondary units as they can get more benefits such as furnished unit from the previous owner. And given the current situation where sales are yet to move forward, we assume that the offering price will remain at least in the short term. In a market that still favors the buyer, competition will remain tougher, and therefore prices should remain competitive and reasonable. Occupancy rose this quarter from 58.2% to 61.4%, mainly propelled by the arrival of new expatriates coming to Indonesia, who help increase demand for service apartment as well, but primarily for long stay purposes, 1 month or longer. And on the other hand, demand from the local clients, especially for short stay purposes, continues to happen. However, the rental rate has yet to regain as it has remained the same as it was in the previous quarter, although some projects have decided to remove some benefits such as free laundry services. That's wrap up my comment on the market. I'll give it to Pak Steve to continue. Over to you, Pak Steve.
Thanks, Pak Ferry. Yeah, the apartment market is still one of the most impacted of the property sectors. Even before COVID, the apartment market was soft with declining sales and oversupply. COVID created even more apprehension in the apartment space due to fear of infection, preference for separation afforded by landed housing, and reduced demand for apartments created by work from home policies. Historically, investors have acquired plus or minus 60% of new apartment development take-up, but uncertainty continues to cloud the space. Investors have less confidence in their ability to keep the apartments rented for income, and also less certainty about future capital appreciation. Although the financial capacity to invest is still there, the willingness to invest remains lacking. The silver lining might be the return of office workers to the office. They need to live somewhere, and not everyone is willing or will be willing to suffer 1.5 to 2 hour commutes each way from home to work and back. Smaller apartments located closer to the office or along public transportation could offer affordability, convenience, and improved lifestyle. This could lead to end user demand and create some traction for the investor-led rental market. The VAT increase from 10 to 11% adds more tax burden and will be a modest disincentive to purchase compared to the positive government policy of VAT incentive that was provided during COVID. Many apartment developers have been severely challenged with soft market conditions while holding large inventories of unsold units. But we have heard some encouraging cases of middle and middle up apartments being successfully rented out to corporates and embassies during the COVID period, creating good cash flows from otherwise unproductive idle assets. Next slide, please. On to TOD. TOD, transit-oriented development, remains one of the most hopeful segments of the apartment market. Up till now, the entire apartment market has been soft. So it cannot really be said that one location or another is outperforming the rest of the market. Certainly, already built apartment projects with standing inventory have been selling better than planned under construction or projects with stopped construction. With the oversupply of apartments, we don't see any way to easily convert apartments to alternative uses. Perhaps converting a strata sales program to some form of rental will be a viable approach going forward. Some of the better concepts that might have faster take-up and better pricing include branded residences and serviced apartments, new co-living platforms, rental apartments, apartments within superblocks, and TOD developments. However, even though TOD is much talked about these days, there have not been any new apartment developments completed next to MRT stations since COVID. So TOD apartment living is still essentially untested. Also, buyers are wary to buy apartments at projects where construction is not actively underway, or especially where construction has stopped. And we've all seen many of those. We also have the LRT due to open fourth quarter 2022. So lots of potential for future TOD mixed use development and apartment living, but no completed projects ready to occupy yet. Therefore, we still find ourselves in a bit of a quandary and a wait and see mode. Next slide, please. On to strategies. A good strategy going forward for soon to be completed apartment projects or standing inventory apartment projects will be to focus on innovative rental concepts, including investment products to sell the rented units. Depending on the location, the unit configuration, and market positioning of the project, some of the more interesting possibilities include co-living platforms, branded residences and serviced apartments, student rental units, internal rental programs, and senior living. For projects in the planning stages or next pipeline, getting closer to the customer through consumer surveys, testing their preferences for location, unit size, configuration, amenities, and budget will be very critical. Better to invest on real data and demand than traditional gut instinct. It's not an easy time for the apartment sector, but I would not count the apartment sector out. Never forget the cyclicality of the property market, and what's in favor now may soon be out of favor, and vice versa. That concludes my comments on the apartment market. Thank you.
Thank you, Pak Steve and Pak Ferry. We're moving on to our last sector for today. It will be hospitality market. Pak Ferry will start to give an overview of what happened on the first half of 2022 in the hotel market sector, followed by Bapak Satria as the head of hospitality services, who will give an explanation and what is the opportunities for the hospitality market in the future. Pak Ferry and Pak Satria, over to you.
Okay. Okay, thanks again, Santi. Okay, now you can see here some chart. Before I started, in order to give you a clear picture of comparison on the hotel market situation before the pandemic and during the pandemic, I'm trying to use different line color here. The red lines color represent the situation in 2018 and 2019. So that's basically before the pandemic, while the blue color lines are hotel performance during the pandemic. So because performance trends in the hotel industry has almost been in the same pattern or seasonal, this sector is basically quite easy to predict. In line with the removal of quarantine policies for overseas travelers, the number of foreign visitors to these three cities, we have Jakarta, Surabaya, and Bali, has shown a steady rise. This gives signal of positive outlook, although it is quite moderate. Two important hotel performance indicators here are the average occupancy rate, or AOR, and ADR, or average daily rates. In 2020 and 2021, the occupancy were below the normal performance, and this is quite understandable because it was the pandemic period. Going ahead, the positive momentum could continue in line with the expectation that the economy and the hotel pipeline will grow moderately. And for the last 2 years, hotel performance has improved, mainly after the government removed the repatriation regulation for foreign travelers. Occupancy rate has shown an upward movement. In April, 2 months ago, occupancy declined mainly because it coincided with the fasting month, and which is a naturally low season for hotel with fewer activities. Hotel rates has been stable in 2022 year to date, suggesting a positive trend, about 80% increase compared to the same period in 2021, and that should be explained in my next slides. Next slide. Now we have the average daily rate information here. Again, the same picture, the same color. Again, we here look at the blue line is mainly due to the slowdown of the business activity during the pandemic, as many restrictions on people movement and activity. Over the last 2 years, business activity in Jakarta and Surabaya has gradually resumed. There are times when travel for business purposes was still allowed. Hotel performance in 2019 was a good benchmark to give a clear picture of hotel trends. Today, with the normalizing trend, we believe occupancy performance has gotten back to normal, although still lower. But for hoteliers, the room rate will be the next homework to improve before to see a stabilized level. The daily room rate performance now is still below 25% from the rate before the COVID. During the pandemic, all hotel classes survived thanks to the support that came from the domestic market, either through room revenue or MICE activities. Several MICE activities during the pandemic were supported by the government activities, but those from private corporation or individual traveler were quite minimal. And with the expectation of more international visitor flowing in, the hotels are conditioned to get back to the level of competition pre-pandemic. And we see that that hotels that are managed by international chain operator may benefit from the global network. That's I wrap up my comment on the hotel. I'll give it to Pak Satria to continue. Pak Satria, over to you.
Thank you, Pak Ferry. Hi, everyone. Well, being the last one is not interested, but yet I'm giving a very interested news for you in the hospitality sector. As you see on the past on the last two slides, actually the occupancy and the rate in some of our big cities are there. If you see, Jakarta itself is getting steady. Even Surabaya, Surabaya is previously it's been the last cities of the hospitality sectors, but it shows that Surabaya is getting stable after the pandemic. Meanwhile, Bali is still not there yet until the last measures, but the good news is that in the past few weeks, in the past few days, even we heard a lot of news that Bali is getting stronger, not only in the occupancy, but also on the average room rate. While they are already achieving the average room rate better than even 2018, while the numbers of occupancy is the most highest during these years of 2020, of the 2000 to 2020. So yes, we are going positive. On the next slide. On the next slide, I would like to show you some of the activities that our government also is giving us a big support. Even though they've been declaring a few years ago there will be 10 more Bali or 10 new Balis, but actually they are now having 5 top priority destinations that they are developing in Indonesia. You all aware that Danau Toba is one of it, and then the second one is Borobudur. The third one is Mandalika, which is Lombok. The fourth is Labuan Bajo, and the last one is Likupang, that located in the north of Sulawesi. I would like to share some of the news that some of the activities that we are getting from the past few months. That we are receiving a lot of inquiries from the land property owners and also some of the hotel operators, that they shows the interest of developing these areas, not only Java and Bali anymore, but they are, since that this 5 priority destination is becoming more interesting for the new destination that they would like to develop. They are asking our assistant not only to see what is the possibility, what is the feasibilities in these areas, but they also asking our assistant to see the life cycles of the hospitality industry itself, starting from the concepting until the disposing of the property. This is quite interesting. It shows the fact that the market is getting stronger, and also the investors is also getting stronger to to the sector. On the next slide, I would like to also emphasize that that we are receiving a lot of numbers of investors who wish to invest and play on the hospitality sectors again in Indonesia. Not only hotels, but also other sector in the hospitality, such as the destination and also food and beverage. They are taking this advantage to be the pioneer in the area and to be the pioneer who is going to awake in the area and gain the advantage of being the first. The next slide. I have been questioned by a lot of not only the people who is already in the management of hospitality, but also from them who is on the baby period of developing their businesses in the hospitality. Is the tourism of industry in Indonesia will coming back? I cannot say yes, but I always told them the fact is that the occupancy is there already. The numbers of the average room rate is there already. And you can ask some of the hotel owners and also some of the restaurants owner and destination owners, how are they enjoying their financial performance right now. Even I can say, but I cannot disclose the name, but I can say that one of the hotel owners in Bali, they say, look, Pak Satria, last month actually is the best month for me because I have been taking 600 million out of my net profit. I say, but your hotel is not big. I say, yes, this is the advantage of being settled and being in the period when we are opening and we are ready to open. We can take the advantage of having a better net profit compared even before in 2018 and 2019. So if somebody asks me again, is a tourism is returning? It is returning, and it is even faster than what we had predicted before. That most probably we might enjoying the numbers of 2019 in 2025, but we already enjoying that number right now. So this is the timing that the industry is changing, and some of them, they are prepared to be the pioneer, and they are prepared to face the new of tourism in Indonesia. There is a lot of challenge that we might see because this period is not easy compared to the previous years. So on the next slide, actually, I would like to show some of the things that our industries have been doing. That now they are really since what is the target market that they are looking at. For example, like Bali before, they are now enjoying the domestic market more than before. They are realized that the domestic market is quite strong, and they are becoming the priority of their market segment. And they are realized that the domestic market is bringing a lot of positive points. They are now concentrate on the experience of the customers, not the luxury investment like what we see before, thousands of rooms, a number of billion of investment in the properties. We are now getting clever, and we are now concentrating on the experience of the customer more rather than concept. And we see that a lot of things are changing. The people who has a different view and different ideas and thinking out of the box are the one who is surviving. Therefore, if you are asking why Canggu is now better than Seminyak and the occupancy is better than the Seminyak, is because the people in Canggu have been enjoying, have been seeing what the Seminyak, Kuta and Lekian have been doing for the past years. They are learning out of it and they do something better than them. I have seen also there is a few movement that is been doing in Uluwatu and Jimbaran area that I believe is going to be happening in the next year or plus, but they are preparing something which is going to be a new Bali. A lot of people is emphasizing on the revenue management definitely, and they are concentrating on their products and services to make sure that their customers, their repeating customers, especially when they come to their properties, are enjoying their property even better in the second or third visit. That's what I can share from the hospitality right now, but from the hospitality division right now. But this is the division that is surviving during the inflation. If you see if we are remembering the years of 2004 during the Bali bombing, during the 2008, actually hospitality sector are the only sector that is there. And during the pandemic, we hit a lot. We are dying during the past few months only, but yet we are here now. Over back to you. Thank you.
Thank you, Pak Satria, to sum up the presentation and close the presentation. And we're moving to the question and answers session. We already have quite a few questions, and hopefully we can answer all. But if not, please remember we will try to have our experts answer and send it to your email address. So we're starting with the investment market, which is a question for both Ibu Monica and Pak Steve Atherton. There are three main topics that is being questioned that we receive in our question and answer box. The first topic is about the interest rate and the US Fed when they increase their interest rate. So Bapak Ignas Kemawarta from Sinarmas and also Bapak Hendroyan is asking Pak Steve, probably, who can answer this question. Will BI will always keep the 7 days repo rate even when US Fed increase their interest? And do you think that the property sector will decline in the second half of 2022, looking at the BI may increase the BI 7 days repo rate to manage the inflation rate, Pak Steve Atherton? Pak Steve, you're still on mute, yeah.
Okay, thank you for the question. I think there'll be more and more pressure on Bank Indonesia to raise the 7-day repo reserve rate as the US Federal Reserve continues to notch up and increase the rates. I think just since the beginning of 2022, the US Federal Reserve rates were right in the 0% range. And just in 6 months, they've raised it dramatically to 1.75. The next increase expected in August, I think, is another full point. And most economists are expecting, the U.S. Fed rate to touch 3 3/4 or 4, or maybe higher. As the U.S. interest rate climbs higher and higher, and investors sell assets in foreign denominated currencies and buy investments denominated in dollars, there'll be more and more pressure on the foreign currencies, and the Bank Indonesia will face that pressure, and I think we'll probably need to respond. I would guess it in the next I don't know, 2 to 4 months would be my expectation. So I would say, let's see, we're sitting here in July, 2 to 4 months, touches before the end of 2022. So yes, I would project and forecast that we may see an interest rate increase from Bank Indonesia before the end of the year.
Okay, Pak Steve, thank you for your answer. An additional question in that note. Bapak Benjamin Mikhail asked whether there's any impact of the depreciation of yen to the property demand.
Well, I think the problem for Japanese investors is that their yen will buy less overseas, right? With the depreciated currency. So it doesn't help property investment sentiment for Japanese investors when their yen buys less than it did before. So it I think cannot be seen as a positive. It's probably, broadly speaking, a negative.
Okay, noted. Thank you, Pak Steve. So move to Ibu Monica. Ibu Monica, interesting question from Bapak Ignas Kamawarta and Bapak Tombak Suhendra. Will there be any impact to the property market in regard to the election of 2024 election that probably the heat will start next year?
Okay, thank you. Yes, I think this is really quite difficult question to answer and quite sensitive, but maybe I can look at this way. The major strategy or the major work that is actually applied during Pak Jokowi era is the massive development of infrastructure. Then this is actually impact in a lot of property, especially landed houses, industrial estate, logistics, and others. So the question is, if within the next president will continue this strategy in terms of developing infrastructure, then maybe the property development, the impact will be actually still positive, because currently the infrastructure works or toll roads not only occurred in Java, but also in Sumatra, in Kalimantan, and also Sulawesi. So if this strategy or this policy continues by whoever after the president is elected, so this will the growth for property will still be positive. So this is actually the question, the major question that we have to see for the next election.
Okay, thank you, Ibu Monica. Last questions topic for investment market in regard to landed housing, and this I think Pak Stephen and Ibu Monica can maybe combine to answer this question. In regard to landed housing, on which category of landed housing that you predict will perform the best, and how is the projection and insight of landed housing post-pandemic up until 2025?
Okay, I will answer it first, yeah, Pak Steve, then maybe you can add on. This question is still general, so I think I will also answer it generally, because usually for landed houses, it will differ from one place to other place. But in general, the major demand or the major potential market is actually for the first-time buyers. So these first-time buyers will, and also if we see from the demographic, this market is really the huge market. So this one is the major market for landed houses. After that, the second market, which is actually also potential, is for the second buyer market. So for example, those person or those families who have already buying for the first time, then after that with their growing income, then expanding family, they need bigger houses, also maybe better location, then they will buy for the second home buyers. Then this is also the big market. So this is actually my answer, Pak Steve.
You're still on mute, Pak. Sorry.
Thank you, Ibu Monica. Yeah, I guess I would only add that, it's very market specific in terms of what price ranges will be the most successful. I would say broadly speaking, when we talk with our foreign investment clients who are looking for joint venture partners in Indonesia, generally speaking, they like to target primarily under 2 billion price range. And then you might find submarkets like in Cikarang, where it's more factory workers, where maybe the target and factory managers, where the target might be more like 1.2 billion and under. So it does get very market specific, but I think you could definitely say that the sweet spot and the highest demand for residential housing is landed. And you know that Indonesian consumers, families would prefer landed housing than any other residential product. But hopefully, again, we're going to see the return to demand for apartments because of lifestyle choices, shorter commutes, and convenience. So we're hoping to see that balance come forward as we see workers getting back to the office. Thank you.
Thank you, Pak Steve. We're moving to office industrial. Ibu Ana Bakri have a question. How do you see the cap rate trend for industrial and office in the coming years? And will it be facing a compression through the years? Maybe you can start with office, Pak Bagus.
Yeah, as you can see, Ibu Anna, is that right?
Correct,
Yeah.
Pak.
Yeah, the office market is facing quite a big challenge in the future years because the supply will still be there until 2025, especially in the CBD area. So when the growth of the economy does not improve, which is right now 5.01% based on Q1 2022. Doesn't improve to 5% in average or even more, the demand for office space will not be growing as big as well. So the challenge is actually demand and supply. And because of that, so there's nothing we can do about supply because the 2025 supply is actually will be there. So the cap rate in relation to that will still be compressed, I believe, in the next few years, and probably until 2024, maybe 2025. In the past, we're looking at 6 to 8% for the whole building cap rate. Right now, unfortunately, the last deal that we had, we're looking at closer to 4%. Yeah, between 3.7 to 4.2%. So right now, the whole building cap rate. Yeah, so that's the big difference right now. Whether or not in the next few years will be better, that depends so much on the GDP growth, whether demand will increase and then catch up with the supply, and also depending on what Ibu Monica said about the election. Thank you.
Thank you, Pak Bagus. Moving on to industrial, Pak Martua, what do you think about the cap rate trend for industrial, and also will it be facing a compression through the years?
Well, yes, to answer Ibu Ana's question, currently the cap rate for industrial is around 8 to 9%, yeah, and still at this moment still flat at that rate. I think the question regarding what's going to, or the trend, I think I agree with Pak Bagus and also Ibu Monica. The thing is depend on the many factors. Yeah, one of it also regarding the election and also the regulation of the development that the government will bring in. Because one of the key for investors for industrial basically the stability. So that's the key. I think it can answer. Yeah. Thank you.
Thank you, Pak Martua. Another question for industrial from Pak Benjamin Mikhail. Do you see a significant arrival of potential buyer in regard to industrial estate? That's the first one. And the second one is, do you think that industrial estate in West Java could receive an exposure in the emerging potential sector?
Yes, to answer Pak Benjamin Michael's question, the first one is about the industrial estate. Do we see any significant arrival? I have to say yes, Pak. During the first half of 2022, once the government lifted up the quarantine and the regulation for traveling due to the pandemic, we see several investors arriving to Jakarta to do site visits. So I think that's to answer your question. Yes, there are some arrivals to see the industrial estates. And number two, the question is, do we think the industrial estate in the West Java could get some exposure? Again, the answer also yes. Why? Because the West Java, if you see the Cikarang, Karawang, that's basically many automotive industry located in that area. Wuling, Suzuki, Toyota, Honda. So that's also will have impact related to the electric vehicle that going to the government, and also the investors is going to invest. I think that's answer the question, because they will ask, where's the automotive industry, where's the area, and that's for sure will give exposure to the West Java industrial estate in West Java. I hope that answered the question, Pak Benjamin. Thank you.
Thank you, Bang Martua. We're moving on to the retail sector, still from Benjamin Mikhail. Sander, do you think that the mall traffic will significantly decline due to the booster vaccine requirement?
My first response would be not really. It also depends if updates are being made to the Peduli Lindungi app, which, as far as I know, only detects 2 vaccinations right now. So I'm not sure if they're going to add a booster requirement in order to get basically the green light to access locations. Also, I would say it depends on how security officers at different malls are being instructed right now, but that's my personal feeling. It seems that they're not really focusing or really checking whether someone is actually checking in at a mall or not. And so that might change due to new government regulation. If they're stricter, then it might decline a little bit. But for now, I would say not really. And it also depends on the type of mall you're talking about, I would say, right?
Thank you, Sander. We're moving on to apartment market. Pak Steve, Ibu Brenda Karisma asked related to the strategies in apartment development. How do you think about the future market of senior living, Pak, in Indonesia? Pak Steve?
Thanks, Auntie. Yes, I think there's only been a few number of players active in the senior market space so far. We've seen some in landed housing format, and one in particular near the airport for a more vertical format. But I think the potential for growth in this space is rising because we have more and more older people, of course, and the ability to have community and senior people living in communities together is really desirable, and it's healthy, and it's very positive for old people. And there are a few companies that we're working with and talking with more that are operators on that side of the business. I've not seen so many foreign investors ready to enter the space in Indonesia, But we have plenty of local developers with land and or buildings that could be suitable for conversion to senior housing. So with the interest that we see to date from some of the senior living operators, I think it's a good opportunity for those that have marketing skill and can reach that community and provide the care that they need. Also, you're going to have different levels of pricing. You know, you're going to have your lower middle cost pricing, your middle sectors, and your middle up or even high end sectors. So there's going to be a pricing and product specific type of strategy that will have to be addressed in each and every case. Thank you.
Thank you, Steve, for the answer. Last two questions because we're running out of time. We only have 7 minutes left. For hospitality services, Pak Satria, Bapak Donan Aditya asked, what do you think about hotel management service market in the next short term, 1 to 2 years, Pak Satria?
In my point of view, is very, very positive because in fact, in the past 2 years, since most of the branded hotels, most of the hotels who have been managed properly by the operators, they are surviving. They are having a very strong support on the distribution channels, and they're also supported by the manpower. In fact, everyone now have a big problem on the manpower. We are having a lot of shortage, not only on the hotels, but also on the restaurants, on the airline, on the in any sectors of the services sectors. We are lack of manpower right now. Therefore, I believe that that the hotel management is going to be strong in the next 1 or 2 years, not even for 5 years in a row. And we all know that most of the hotel operators now is getting stronger because they are strengthened their numbers of hotels that they are managing for the past 2 years, and they are preparing. Actually, all of them are preparing that they are going to be stronger in the operation and support. And this is to show to the owners, to the hotel owners and the investors that they are ready to face anything in the future. Back to you, Andy.
Thank you, Pak Satria. Last question for today from Bapak Sami Luntungan, and I think Pak Mike can answer this question. How about property for foreigner? We are waiting for legal aspect, Pak Mike.
In general, I'm not too optimistic, especially as we approach the election in 2024. It's a politically hot topic. And I think in general, most government officials and politicians will stay away from it. The one possibility, however, is in the omnibus law, there was a certain amount of freedom given to special economic zones. And I know, for example, there are several special economic zones being planned in Bali and also even inside Jakarta, which will allow freedom, for example, for hospitals where foreign doctors can practice. And I suspect that you might see the ownership by foreigners of apartments, for example, first start in the special economic zones, and then maybe after it doesn't look so dangerous, maybe it will spread. But I've been hearing about foreign ownership of apartments ever since I moved here in 1992, and that's almost 30 years ago. So I have to say my optimism is a little bit tempered.
Okay, noted, Pak Mike. Thank you for the answer. That will wrap up our session for today, Bapak dan Ibu. Thank you for joining our webinar. Don't forget that maybe if you join this webinar late, we will send the recorded version. You can download the link and also the slides to this presentation to your email. Thank you for joining. For those of you who we still have a few questions that we won't be able to answer due to time. Our team will and experts will send an email directly to your email inbox, so to answer to your questions. Thank you for joining, and hope you have a wonderful time and benefit from this webinar. Thank you and good afternoon. Bye-bye.